We're heading for the biggest crash since the Great Depression, and it's just around the corner, according to Harry Dent, who's back in Australia, well, at least virtually, because he's doing a virtual seminar telling anyone who's prepared to listen that we're heading for a stock market crash, a major depression, and that the value of your home and my home will drop 40%, maybe even 50%. Well, really? Today we're going to have a chat with Harry Dent, and I'm also going to have a talk with Pete Wargent, and Pete and I will give you our views. Now, before I explain a bit more about my chat today, I also want to share with you, coming up will be a chat next week with Robert Kiyosaki. Robert Kiyosaki needs no introduction, but I'm also going to ask his views about coronavirus and what's going to happen to our economy and our property markets. And to be blunt, I've already done the interview where it's being produced at the moment, and you're going to hear some very interesting ideas next week from Robert Kiyosaki. But today, let's get back to Harry Dent, who's become famous for his predictions, and he comes to Australia every couple of years, usually when he's got a new book to promote, and he throws the cat amongst the pigeons by predicting Armageddon. And in the process, he gets lots of publicity for his books, his newsletter, and his seminars. Now, a couple of years ago, I interviewed Harry when at the time he suggested that property values would fall 40%. And that hasn't happened, has it? So I guess we've got to ask, is he right this time? Why would he be right this time? Is the stock market going to collapse? Is the world going to fall into a deep recession? Now, I was asked to interview Harry for my podcast, and I was pleased to take up the opportunity. Firstly, I wanted to hear what he had to say firsthand myself, rather than just poo-pah his thoughts without giving him a fair chance to get his point of view across. And I also wanted to give you the opportunity to hear what Harry had to say in a longer interview rather than the short grabs the media normally gives him. Now, I don't agree with much of what Harry said, but I've also learned not to go around with blinkers on and just look at my own confirmation biases and only believe things I already believe. So I enjoyed my chat, but rather than debating with Harry, I wanted to give him a fair go at getting his point across. And as I said, I'm then going to have a chat with Pete Wargent, and we'll give you our views so you can come to your own conclusions. We'll let you know what we believe is ahead for our economy and the property markets. But before I get into the interview, I want to give you a word of warning, especially for the faint-hearted. There are some really scary predictions made by Harry, so please listen to the whole interview and don't sell up your assets before you hear my views and those of Pete Wargent.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator, who has once again been voted Australia's leading property investment advisor. That's the 5th time he's won a similar award in the last 7 years.
It's great to have US demographer and author Harry Dent back with me again on today's podcast. Harry is a Harvard MBA graduate, a Fortune 100 consultant, and his demographic-based approach to economic forecasting has helped him correctly predict many major economic events. He predicted Japan's 1989 economic collapse, the 2000 dot-com bust, and interestingly, the populist wave that enabled both Brexit to occur and Donald Trump's election. So welcome, Harry.
Yeah, nice to be back, Michael.
Now, Harry, I know some of my regular visitors will think I've got a different point of view to you on what's ahead, but I'm looking forward to our chat because I'm sure you're going to share some alternative viewpoints. And as an investor, I believe it's important to listen to others rather than just moving forward with blinkers on, believing my own preconceived views of the world. In other words, I don't want to be blinded by my personal confirmation bias. So, Harry, I believe you're suggesting an economic winter is coming. And when it does, the fallout's going to be even worse than the Great Depression. Why do you think that's going to happen, Harry?
Well, first of all, this happens every other generation. And we have four seasons I describe in my books. You have a mild spring boom with inflation, minor inflation. You have a summer inflation period like we had from 68 to 82. And then a bubble boom like this with falling inflation and strong technologies like the internet are moving mainstream. And then that bubble ends up going into a winter season where we have to deleverage all the companies that started up and didn't really make it, all the bad debts. Debt bubbles cause financial asset bubbles, and people start speculating too much. And that's what we had from 1929 to 42, particularly 1929 to 32. So this is more like that. It's the winter season. We have to deleverage these bubbles. And of course, in Australia, the biggest bubble is not the stock market, although that's up there, not quite as bad as ours, but it's your real estate bubble is your biggest bubble. And that's where your biggest exposure is.
We'll get into the real estate market in a moment, but how do you know for sure we're in a bubble?
Michael, I have to laugh. I get that question all the time. I'm like, looks like a bubble, walks like a bubble, quacks like a bubble. It's a bubble. You look at this stock market. I've got it in all my books. This boom is nothing like the 1942 to 68 boom for the last generation. 20% corrections at worst, nice, orderly 7-8% gains, a year. This boom has been bubble from the beginning. The first run up in 87 saw a 40% crash, most of that in a few days. That never happened in the boom before. And then we get the tech bubble that peaked in early 2000, and then bam, even though in the middle of strong demographics and the internet still moving mainstream, we had a huge crash in stocks, which normally doesn't occur in most booms. And of course, when the baby boom finally peaked, which I can predict very accurately, late 2007, and they're spinning, and the bubble really started to unravel then. Well, central banks stepped in and printed like 16, 20 to $20 trillion in the years after that and created a bigger bubble than ever in the slowest recovery in history. So bubbles have a certain progression. They have a final blow-off phase, which started with Donald Trump getting elected, and then with the repo crisis and the Federal Reserve pumping in $760 billion in a matter of weeks here. And now it's starting to blow. And I warn people, bubbles, the first crash is always about 40%. That lets you know, it was 39% in Australia, by the way. That lets you know it's over. Then you get a nice rebound for 3, 4, 5 months. It says, oh, no, it's okay. The government's going to fix everything. And then you go into the deleveraging stage, which lasts over 2 years. These things are not black swans, Michael. And we do now know this has started. The NASDAQ, the tech stocks may make a new high, but I don't think most other stock markets, and certainly not the ASX 200, does not look like it's going to make a new high. And I think the next 2 years after this year, after this election, if Donald Trump gets elected or not, doesn't matter to me. He'll wish he hadn't if he does. We're going to go into the worst downturn. It's going to be like 1930, 31, 32. And you just have to let these bubbles deleverage, debts be written off. It's very painful, but it makes the economy healthy again so we can grow. And Australia's got some of the best growth prospects of any developed country in the world once we get over this global bubble and your real estate bubble, which is the second or third worst in the world.
Well, we'll break down a few of those points, but can I first ask, does the bubble actually have to burst? Can't it just deflate slowly, Harry?
Well, I asked men about this. I actually compare, and I used to do it as a joke. I don't anymore because financial bubbles have the same pattern that Masters and Johnson showed on the male orgasm. I'm not trying to be funny here. It is the same thing. It's an exponential rise. It gets so intense it can't sustain itself, and it finally bursts. When an orgasm is over, it's over for the male. When bubbles are over, they burst dramatically. I've had people, Michael, for the last couple of years, I say, hey, this first crash is going to be 40%. They said, Harry, central banks will never let that happen. What's wrong with you? It just happened. It happened so fast, 5 weeks. We eliminated $20 trillion in financial worth, real money in people's brokerage account in 5 weeks before the Fed could respond. And of course, now we're bouncing. No, they couldn't stop that. And that's the thing. Bubbles are a predictable phenomenon. I've been tracking this thing. And I said, when Trump got elected, we're in the final phase. And when the Fed started suddenly panicking and pouring hundreds and hundreds of billions of dollars, and the stock market went straight up with it in the final move, I said, this is the final orgasmic move, and it's peaked. And now we follow a pattern. So if you understand bubbles, they're easy to spot. What's more obvious than stocks going up at astronomical heights or real estate going from 3 times income value to 10 times in Sydney and Melbourne? What's not up? That's a bubble, period.
So how bad will the crisis get this time, Harry, if the bubble is so bad?
Well, again, it is typical. Like normal, when I every 40 years, I've shown in all my books, and a lot of people are familiar with that. I call it the spending wave. Any country in the world, but most developed countries followed a similar path. A boom from 1983 to 2007, and then it slowed down. Every 40 years, we get an extended downturn, like 68 to 82, or now 2008. By the way, we already ended the winter season in 2008 to 2022 to 23. And in this case, we're going to have the final bubble and the worst burst at the end of the winter season from 2020 to 22, instead of at the beginning as we had last time from late 29 to late 32. But it's the same thing. It's deleveraging the debt and the financial bubbles, which all get in the way of growing again. You can't grow when young families can't afford a house, which they can't in Australia. You can't grow when young families that they invest for their retirement can make no returns because stocks are already 30 times earnings and there's no way to grow from there. And you can't grow with a lot of zombie banks, zombie companies, and zombie debt. Ask Japan, Michael, who 30 years now went into winter ahead of us and has never come out because you know what? They never deleveraged their debt or their bubbles, not a bit of it. And they're just in a coma economy. And their demographics are the worst in the world on top of that.
Well, Harry, I know you look a lot at demographics. You use that to predict what's going to happen in the future. And that's one of the things I learned from you many, many years ago from your first book. So what are the demographics indicating is going to happen to us now?
Okay, first of all, the developed world, Europe, North America, Australia, New Zealand, East Asia, Japan, Taiwan, Korea. At different times, Japan was the first, actually Korea, South Korea is the last, but we all peaked generally around 2007 to 10, Europe a little later, US and Australia first. So that was the demographic peak.
What peaked? Sorry to interrupt you, Harry. What peaked?
The baby boom generation, you've heard of them, right? The largest generation by far ever born, especially in the developed world, has peaked. And that not just created the greatest boom in history, it marks the peak of the developed world in general. After this generation, we don't go to new heights. Now, Australia does by a good margin. But most of North America, most of Europe, and East Asia never get back to higher levels of economic growth, higher numbers of houses and cars and spending needed for decades and decades to come. Australia is an exception for one reason. You're not having any more kids than we did after the baby boom. You have a steady flow of high quality Asian immigrants that make your spending wave chart that I project in the future continue to go up as if you were Southeast Asia instead of a normal developed country. So the emerging world is going to merge out of this the strongest. Out of the emerging world, now that China has greatly overexpanded and already largely urbanized, it's going to be your best neighbors, Southeast Asia and India in particular, leading the next boom and emerging countries in general. So you not only have better demographics than almost any developed country, and you do have higher growth in the future, new heights and demographics, but you're on the cusp of the leading edge of the world, which is all going to be about Asia. It started with Japan and China, but India and Southeast Asia are going to take it to new heights, and you're there. And you know who's closest to that? Perth. You know, if you had to pick a city that's the closest to that boom, you'd have to say Perth.
So Australia's in a great position to take advantage of the next wave, and we'll have a talk about that in a moment. But I just want to catch one other thing that you said a moment ago. You said that there was no black swan events or X factors. I've read you say that before, that these aren't unforeseen events coming out of the blue. I don't believe you don't think that's actually the case, Harry.
Oh, okay. This bubble is clear. It's clear this bubble is going to burst. I've been saying that, but you do need a trigger. Last time it was the subprime crisis in the U.S. You know what the Federal Reserve and Ben Bernanke and economists said about it? Oh, that's just 14% of consumer debt, and it's under control, and we got derivatives to insure it and all this stuff. Baloney. That was the biggest scam in history. That little subprime crisis, which, by the way, was only in 4 states and 1 country, the U.S., and then a little bit in Spain and Ireland, set the whole world down. Well, it's because we had a global demographic boom starting to decline, and unprecedented debt around the world. So that was just the trigger. This virus, now that was a black swan, okay? I was expecting a big default in the Chinese developers, or an emerging country like, Turkey, and Argentina's already starting to follow Venezuela. I was expecting debt defaults in the corporate and emerging world to be that trigger, but the virus came, and oh man, it's the perfect trigger, because money printing and all types of financial support can stop a lot of things, a stock crash, a recession, at least temporarily. It doesn't do one thing to stop this virus. Only lockdowns do. And lockdowns cause a sudden deflationary demand shock to the economy. And deflation is exactly what the winter season and deleveraging. And as I was starting to answer you before and I forgot, the difference between this downturn and an ordinary generational downturn, which is about 50% down for stocks, these tend to be 70 to 80%, because the deflation and the deleveraging is so hard on the banking system and corporate and bankruptcies and unemployment. Unemployment in the 30s hit 25% in the U.S. It only hit 11% at the worst in the whole 70s down, series of recessions over 14 years. So we're heading for that. We've already got, I'm telling you, when this employment report comes out in the U.S. tomorrow, Friday our time, Saturday your time, it's going to probably be 16, 17%. That's depression levels. And it's probably going to get to 2025 sometime into this next year or two. And that is something we have not seen in our lifetime, but we did see on the 80-year cycle, 2 generation cycles in the 30s. And every 90 years, we get a super bubble, not just an ordinary bubble. And that last one, the central bank stimulus has just driven this baby boom wave already into this final bubble that, instead of coming early in winter, came late in winter, right on a 90-year cycle. And I tell you, Michael, I look at a lot of charts. I've known this for a long time. It took me a while to explain it. The most obvious thing on the long-term chart, all the way back to the stock exchanges in the US and London, that basically every 90 years you get a super bubble and you get a major crash and a depression. The Great Depression, before the Great Depression, was 1837 to 42. And then, of course, 29 to 32, you go 90 years. Here we are, late 2019, early 2020. I've had late 2022 on a number of cycles coinciding for my entire forecasting career since the 80s, saying that will be the bottom of the biggest crash in our lifetimes, and that will be the bottom of the winter, the next winter season coming. I was saying that back in the 1980s, because these cycles are so clear. 40-year generation cycle, 20-year cycles, 10-year cycles, and then this super duper 90-year cycle. It's so obvious if you look at stocks long term.
Now, I know some people are going to be saying, oh, but Harry, you're a perma bear. You've been negative for a long time.
No. Hey, is anybody listening? Michael, that is so wrong. I was the most bullish forecaster in all of history. I got insulted for saying in 1989 that Japan was going to crash for 14 years and the U.S. and Europe were going to have the greatest boom in history, when people thought we were has-beens. I look at the facts. I am bullish. I've been bullish most of my career. Every boom, every bubble has to burst. I'm talking about 3 years of a big deleveraging, which occurs every 80, 90 years anyway, right on cycle. And people asking like I'm a perma bear. This is utter nonsense. People criticize me. They better know what they're talking about, because I'll come back at them. This is baloney. I'm the most bullish forecaster in history. And I say we're in the greatest economic explosion since the late 1800s. And life expectancy, standard of living, there's nothing to compare to in all of human history. And we're only halfway through it. This is going to go until 2150, when my grandkids are alive.
So you see some great times ahead.
Yes.
But we've got to get through what we've got ahead of us at the moment. So with an economic crisis coming, or actually already happening, is there, in your opinion, any safe haven for people to invest?
Yes, there always is. The winter season has the fewest. But yes, and you saw it in this first crash. It was already demonstrated. Stocks went down 35 to 40% in different major indices around the world, close to 40% on average, exactly what I was expecting, regardless of the trigger. And now we get a rebound for 3, 4, 5 months, likely to last close to the US election. That's where we are now. So we're going to get this rebound. We've already seen most of the gains. We'll probably see a little more in the next few months. It'll get choppy from here. And then all of a sudden, we're going to realize, a lot of these businesses that failed, big and small, and because of the virus, even if the virus doesn't come back, a lot of them are not going to come back. Hey, I went through the hurricane in 2017, the worst in 100 years in Puerto Rico. We had 20% of the restaurants around me never come back, and many, many businesses never come back. Warren Buffett said, when the tide goes out, you see who's swimming naked. We have companies over leveraged. My favorite retailer in the U.S., Neiman Marcus, is about to go under, not because they're a bad store, but because they borrowed too much money in a bubble move when it's cheap to do so and everybody leverages up and lives on speculation. Companies have been buying back their own stocks with trillions and trillions of dollars to goose earnings per share when their earnings have been almost flat for several years. This is a fake boom, and this virus is the perfect trigger. So the safe haven, we just saw it. Treasury, the high quality, the 10-year and 30-year U.S. Treasury bonds, the safest in the world, went up 24% while stocks went down 35 to 40. Australian government bonds are some of the safest. You have the lowest debt. You're not the reserve currency and all the stuff we are. You have stronger demographic trends. So Australian government bonds do well. Gold did good at the first. There's something wrong. And then as soon as it showed how deep, gold went down 10%. Gold did okay, but did not hold up. The surprise to me, Mike, there's one surprise. A normal safe haven would also be the AAA, the highest quality multinational corporate bonds. They got knocked by the virus. The virus is so undiscriminating, that it just hits some companies so bad. I don't care how good your credit rating, your sales like a cruise ship or airlines down 50, 80, 90%, you're a junk bond overnight. And so that was one that didn't work, but it's the high quality bonds. Gold does okay, but is not the safe haven when it sees a downturn. Same in 2008. Gold went up in the early months of the 2008 crash and then crashed along with silver into the worst of the downturn. So it really is high quality bonds, cash, real estate investment trust, and things like apartment buildings where rents are actually helped during a downturn when people can't buy. Medical rentals and properties do well, but you know what? Commercial gets killed and stocks get killed and residential real estate gets killed. And commodities, of course, as you've seen already in Australia.
So that's your advice to investors. But what about business owners? A lot of people listening to this are in their own small business. And I agree with you. They're closing down. We've got our lockdown here. Even that's slowly being released at the time of our recording of this. What should a business owner do? What's your advice to them?
Well, there's two things. And remember, and this is part of the pattern. I've been saying this from the beginning. You get that first crash, you're going to get 3, 4, 5, maybe 6 months of reprieve while everybody's saying, it's no big deal. Okay, well, first thing, consider if you're thinking of getting out of your business down the road anyway and don't want to pass it to your kid, sell it now. It will be worth maybe a third 2 or 3 years from now. If not that, equally good, even better, if you hunker down, this is about a shakeout. It's about getting rid of the bad banks, the bad companies, the bad debt, and making the economy healthier. It means it shifts market share to the companies that are the most focused and have the lowest cost and the least debt. If you get focused and cut your cost ahead of your competitors, guess what? Even if you're not growing because the economy's going down, your competitors are going to fall. Not only do you maybe double or more your market share from them failing, but also in bankruptcy, you're likely to be able to pick up their assets with no money down, just taking over their loans because you're proving to be a survivor and they're not. This is the greatest opportunity. I always give Michael 2 quick examples from the 30s. Joseph Kennedy, investor, got out of stocks at the top when the shoeshine boys were telling him what to buy, got back in. He went from a mere multi-millionaire bootlegger to a billionaire political dynasty, largely because of that one move. General Motors had been number 2 to Ford the whole boom from the early 1900s and passed Ford in the early 30s because they were more focused, better marketing, better financial controls, never to be caught by Ford again, number 1 car company, and ended up being the number 1 company in the world into the 60s and 70s. If you hunker down as a business and focus, this will be the best time in your history. but it won't be if you don't see it coming and you end up in the bankruptcy courts.
So downturns like this have always been a great time for the transfer of wealth. It's a great time for people who can focus on the long term. We're probably going to disagree on the next one, but that's okay, Harry. What do you see happening to the property market in Australia? What's your prediction for the capital city prices?
As anybody knows, Perth has already been hit by the commodity crash. So it's been flat to down. So it's probably got maybe 10 or 20% downside. Adelaide's kind of like our Midwest, not as bubbly, not as fast growing, not as glitzy. So, maybe it's down 20, 30%. Sydney and Melbourne especially in high end real estate, I think down 30, 40, 50%. Now, that is not as bad as a lot of places are going to be. But you have had, Australia has had it in compared to income, your real estate in Australia is second only to China, with Hong Kong at the worst of that, and equal to the worst cities. Melbourne and Sydney are very similar to Vancouver and Toronto. You got to remember, the U.S. got hit last time, so we're not as bubbly, even though we are, as you. So you do have substantial downside. 75, two statistics are important, Michael. 75% of bank loans are exposed to residential and commercial real estate in Australia. 67% of consumer household net worth is in real estate. And a lot of your superannuation funds are in real estate as well. In the U.S., you know what that number is? 30%. And our banks are probably more like 40, 50% exposed. So you have demographic trends that if it were not for your real estate bubble, you would have more like a deep recession, while the rest of the world has a deep depression. Your real estate is what brings you down further. I see your stock market down maybe 60% from the top. I'm seeing US down 80, 85%. I see your real estate down 20, 40, 50%. I'm seeing US 30, 50, 60% in places. And China could see 60 to 80% falls in big city real estate like Shanghai, Beijing, and Shenzhen. That is not going to be pretty. Chinese have 75% of their net worth in real estate, the highest in the world.
Harry, I agree with you that a large part of Australia's assets are in real estate or our superannuation funds. No argument about that. And clearly there's been a lot of speculation in Australian property. We had a boom a while ago, finishing about 3 years ago, with overseas investors. They were buying apartments in those high-rise towers. They were built out of paper mache. I don't know if you know about all the structural problems that were occurring with some of those high-rise inner-city Legoland towers. And yeah, there's been some local investors who bought cheap secondary properties, and they're likely to get caught out. But what about the capital city properties where 70% are owned by mums and dads, owner-occupiers, and half of them don't have a mortgage? And the other half, a lot of them have prepaid their mortgages, having paid the same amount of money over the last couple of years as our interest rates have fallen. Even in the Great Depression, property values didn't drop significantly. Actually, they've never dropped in Australia anywhere like that. Now, we say Australia is different. What would your argument be?
Well, first of all, in the Great Depression, borrowing was not easy for real estate. 50% down, 5-year balloon mortgages. So you couldn't speculate on that. And people had plenty of equity, like some people do in Australia. But you may be saying, yeah, a good many of older people don't, but a lot of younger people do. The overvaluations, 9, 10, 11 times income. High-end real estate always falls even more. The first hit in 2017, which I was in Australia back then, saying, look, this is just the appetizer. And now this virus is the second one. The main course is coming. Now, I have to estimate something like this. You are different. Your demographics in particular are different. But just the fact of what you said earlier, that the leading edge and high-end buying has been by foreign investors, particularly Chinese, is a bad thing, because the Japanese were doing that in the late 80s. And when their real estate bubble burst, they drew their money from around the world first. And everybody got hit. Pebble Beach was on sale 50% off, places in Australia. So the fact that the valuations are so high and that foreign buying has been a bigger percentage. There's more Chinese foreign buying in the US, but we're 330 million people, okay? 13 times your economy or something. The percentage of foreign buying has been one of the highest. Singapore and Australia got to be the highest in the world. So that's a vulnerability. These people pull out. Who replaces them? They're the ones that pay top dollar and buy all cash. they're going to be selling real estate. Your superannuation funds, to be able to give these 20,000 refunds that the government's allowed, are having to sell real estate. People aren't selling real estate in their 401k accounts. First of all, they don't have as much money in superannuation as you guys do. But they're having to sell. That's going to knock down real estate prices, even if good old mom and pop only have 20% debt and don't sell their home. You don't have to sell all homes to have a real estate crash. And again, we're not talking going down as much as stocks. It's probably between 20% and 50% max in Australia. And the higher end is going to be more. And the big, the bubbly cities like Melbourne and Sydney are going to be the worst. And that's just the way it goes. The bigger the bubble. Here's a good way to gauge it, Michael. I'm just talking about going back to 2005. 14, 15 years ago. That's not long, given how much real estate's gone up and how long and how much. That's the prices you should look at your property, whether it's commercial or a big house or a small house. And a small, less bubbly house isn't going to be up as much. See what your home or your real estate was worth in 2005 and ask yourself, am I willing to take that big a drop? If you're not, sell it. If you are, keep it, because this real estate downturn, even if it's less than, I say, 20, 30% on average in Australia, like the Great Depression in the US when there wasn't such heavy borrowing and as big a speculation, then it's just going to make real estate more affordable and make your immigration more attractive. And again, Australia is a place I would buy real estate in the downturn. There's a lot of countries in Europe and even a lot of parts in the US I wouldn't buy real estate when it hits bottom, because the baby boomers dying are going to offset the millennial generation's buying, and there's going to be net slowing down in demand for real estate in most developed countries in the world for decades to come. Less so in Australia, but by 2025 or so, not too far after this bottom, your long-term net demand, when you subtract the buyers who are sellers from the peak buyers, never goes higher than it was in recently and again in 2025 or 26. So real estate's not going to be the killing it was, but I would buy good real estate when it's down in Australia, because you do have much more demographic growth. We do. We're going to never need more homes than we have in the US. Never, ever again. Japan already has 10 million empty homes. It's going to be 15 million before you know it. How do you have a real estate boom out of that?
So we're going to be underpinned by the immigration, which is one of the things that's been supporting our economy for the last couple of decades anyway.
Yes. And real estate, you have scarce property for development, much like California. People say, I don't understand Australian real estate. It is very much like California, where I spent 22 years, because it's a nice place that people want to move and grow. And they got scarce property. If you go to Texas, you can build forever. They say you can watch your dog run away all day in Dallas. Just flat, green. No limits to development. You know what Australia is like. You know what California is like. It's a coast with mountains and desert within. That's a good thing for real estate.
It is. So you're saying an economic downturn is always a good time for resetting of our economy. It's a necessary part of the cycle. It's a time of transfer of wealth. So what upside can you see once we're through the downturn?
Okay, young families can afford to buy a home again. That's good. People are spending less time. If people are spending a lot of time fixing up homes and flipping them, does that really add to your competitive balance and experts in the world and stuff? No, it doesn't. Here's the key indicator for me, Michael. It's a great one. It's called money velocity. Money velocity measures whether money's being productively invested and repaid and then reinvested. You know that Australia, despite your incredible economy and your incredible demographics, has lower money velocity than the US and lower even more than Europe. And that the two countries that have the lowest money velocity in the world, just guess who they are. Japan, who's on their back for 30 years, and China, who's about to be on their back for 5 to 7 years. Those have the lowest money velocity. Big bubbles mean speculation, not productive investment. That's another problem. You got to get rid of the bubbles. If you're in Australia, of course, I don't blame people for speculating in real estate. My God, you're in la la land. But bubbles come to an end from their own extremes. You don't even have to have a trigger at some point. Real estate gets so expensive. Right now in New York, you got to be a billionaire to buy a Central Park penthouse. A billionaire. There's not too many of those.
So, Harry, what would you say to listeners who've been following you over the years? You were on this podcast in 2018, just 2 years ago. You were here in Australia in 2014. You were here in 2011, 12. And you then said, we're going to have a crash. Your homes are going to drop in value. What would you say to somebody who 2 years ago, 4 years ago, 8 years ago, went to one of your seminars?
Michael, it's called a newsletter. Nobody with so much changes in the world and globalization and a virus that comes out can predict everything. And governments have literally just stood straight up and said, we'll print unlimited amount of money. This has never happened in history. I would have thought there would have been a limit to that. No, there has not been. But see, you can see now this thing's been a big enough of a shock, and the governments could not get ahead of it. They didn't get ahead of the 2008 crisis later. By the time they printed money, stocks were already down 50, 60%. We were already in the deepest recession since the Great Depression. So I have a newsletter. I got back bullish again when Trump got elected by surprise. And we warned people, since Trump was appealing to the most pissed off people, the all-star wrestling fans, I call them, that he had a better shot of winning than people thought. When he got elected, this is going to be business stimulus on top of quantitative easing. And then when this repo thing said, I said, well, that's the final thing. So the only way to keep up with me is to be on my newsletter. We're in unprecedented times, uncharted waters, but I still have said, a bubble is a bubble. This is going to burst, and it is now starting to happen. So if you do want to listen to somebody now, I'm telling you, Michael, nobody's going to figure this out. It's a piece of cake to me. I've studied every bubble in history. Again, little bit of weird stuff, especially with the virus, but there's nothing black swan about this. This is following the playbook already. Now, we'll see. I would say if it continues to follow playbook, by late this year, despite all this stimulus, early next year, we start to weaken again. And next thing you know, my God, no amount of stimulus is enough.
So what you're saying really is this is a continuation of the bubble you talked about before. Now,
this is the bursting of the bubble, finally. Bubbles burst, and they burst violently.
I'm going to put a link to your newsletter in the show notes so people can get to your website and find out. And you're also coming to Australia shortly. Well, you're not really because of this social distancing, but you're coming virtually. And I'll put a link to that one-day seminar you're putting together too. And people can go to robertandharry.com to find out about it. But you are coming to Australia virtually. You are doing a full-day event. And what message are you going to give to Australians when you do put on that event?
That is March 24th, 9 to 3 p.m. I was supposed to be on tour in Australia in May, and obviously I can't for those reasons. So I'm bringing Robert Kiyosaki, Rich Dad, Poor Dad, the biggest selling personal finance author in history. Reason I'm bringing him, he's a personal friend, but he does. Most mainstream experts will never admit you could have something this deep. He sees how deep this crisis could be. We're having Martin North, who I tell people I'd give an arm and a leg for a Martin North in the United States. He's the best real estate analyst I've seen anywhere, and he's in Australia, and he's been on 60 Minutes warning about this real estate bubble and crash. He's going to be there. So this is going to be a 6-hour thing. I'm going to open it up for an hour and a half. Martin and I are going to do Q&A at the end, and right in the middle, you're going to get Robert Kiyosaki, who has not been to Australia in a long time, and I plan to get him there live next time I come out there too. So this is going to be a great event. And again, you can also go to harrydent.com.au. That's another website. So definitely sign up for this. You don't have to come, but at least sign up and get a ticket, because this probably will sell out, especially with Kiyosaki on the bill.
Well, we're going to have Robert Kiyosaki on the Michael Yardney podcast next week, and I'd be interested to hear his views as well. So that'll be great. So give us a snippet. Give us a little bit of a teaser. What are you going to be telling people?
Well, we're just going to come at all angles. Robert's really big on the best way to create wealth is to start your own business. I'm like a strategic economist. How do you position your business and your investment? My whole thing is very different from economists. You have to have a different investment strategy for each season. Spring, summer, fall, and winter favor different investments for long periods of time. And so I'm just going to show people how to set up. We're going to have this summer to position yourself. Doesn't matter if you missed the first crash. I knew nobody'd listen to me on that. Michael, they never do. Okay. That was a given to me. Now that it's happened, take it more seriously. Okay, we can prepare. We can see what did well in this crash, what to modify for the next one, and position people. I'm telling you, overnight, you just preserve your money in real estate and stocks and gold and stuff at the top of a bubble. And yes, gold's going to go down too, from my view. Robert Kiyosaki and I only disagree on one thing. He thinks gold's going to do better than I. But we're going to show people how to position yourself and not only make money on top of preserving it in the downturn, but then be positioned in the best sectors. I'm also going to be telling people the next global boom is not going to be like the last one. Like I said earlier, emerging countries, India and Southeast Asia, more than China. Australia, aging industries, my God, nursing homes, assisted living, pharmaceuticals, vitamins, cruise ships, if they ever come back, are just going to keep riding the baby boom wave. And the baby boom wave, even in Australia, is still the most powerful wave. So it's all about strategy, but it's about timing. Now we know where we are on the map. I've had to be guessing at this bubble. Now I think we know where we are and we know what to do next. And we've got expert. We're going to have Sean Allison. He's an expert at making money in up and down markets. And these down markets are equally violent on the upside as well. So we've got a whole ream of experts, Martin North on real estate. Give you all the information you know to make your decisions. Because like you say, nobody's going to agree with everything I say, or Martin North, or probably maybe Kiyosaki a little more. Everybody loves him. But, know what you're doing here and make smart decisions. This is nothing to fool around with. And what you can't do here, Michael, is listen to the typical financial advisor and politician and economist that says, don't worry, everything's going to be okay. Stocks come back. Last time we had a bubble like this burst, 89% for blue chip stocks down over 3 years. And it took 24 years. Let me repeat that. 24 years just to get back to even. A retiree just entering retirement in 29 would have died before they got back to even. That's how this is not something to sit through. You better hedge in some way, or at least even if you respond late, you're going to be ahead of the crowd here. Same for your business. So I see this. I'm excited. This is the greatest opportunity. There's no way to make more money as an investor or to gain more position as a business than the next 2 to 3 years, but only if you know that it's likely to happen and see it coming. If you wait until it happens, you're dead. You're already bankrupt before you can pull your gun.
Well, there'll be a link in the show notes again, so people can click harrydent.com.au or robertandharry.com. Harry, I really appreciate your time that you've given us, your insights. And as I said at the beginning of the session, I believe it's important to go forward without these blinkers on and look for opinions, especially with people who've got a bit of a track record. And while we don't fully agree, I do appreciate that you've given us your time, and I look forward to actually hearing a bit more at the new upcoming seminar. Thank you for your time, Harry.
Oh, thank you very much, Michael. I enjoyed it.
Well, I warned you at the beginning of the podcast that there'd be some scary predictions from Harry Dent. But before you get too nervous, let me suggest that you take the time to hear what Pete Wargent and I have got to say, because we have very different opinions, as do a number of very credible economic commentators, economists, banks. Now, some people will say, well, these economists, these banks have got vested interests. Maybe they have, maybe they haven't. So let us give you our thoughts in just a moment. But let me say that how I get my thoughts isn't just from my gut feel, but because we do have a team, a panel of experts that we turn to when looking for advice. And I'm going to suggest that you do much the same, because for those of you who believe there are going to be opportunities that are going to occur once we get out of this coronavirus cocoon, and I'm one of those, I believe you should be getting yourself set for taking advantage of the markets, because, yes, we are going to have a bit of a tough time, but not for as long and not as deep as what Harry suggests. So if you're wondering what's going to happen to property in 2020, 2021, if you're looking for some guidance, some direction, some results, why not have the team at Metropole help you be on your side? In challenging times like we're currently experiencing, you need somebody who's got the perspective, a team that's got the perspective, that's lived through not just one or two downturns, but a number of them. And no one's got the same level of perspective as the wide-arching team at Metropole. Go to metropole.com.au and you'll find out that we can give you strategic property advice. We've got Australia's largest buyers agency. We have wealth advisory with Ken Race. We've got property management, property renovations, property development. By having a holistic approach, now you may not want to use all those services. You may just want to use one or two. But by having a holistic approach, by actually tying all these things together, you're going to be able to find the direction, the guidance that you need and get wealth producing rates of return from your investments. Go to metropole.com.au to find out how we can help you. And now let's have a chat with Pete Wargent to burst Harry Dent's bubble. Well, we've heard Harry Dent's view that we're in a bubble that's about to burst and give us the worst depression for 100 years. But what about an alternative opinion? Because while Harry makes some good points, there's a whole lot of things I disagree with. And who better to discuss it with than Pete Wargent, who's a chartered accountant, a chartered secretary, has a financial planning diploma. But what's more important to me is he's used his own long-term approach to building businesses, investing in equities, owning a property portfolio that's given him the financial independence that most other people would want. In other words, he's a doer, he's achieved things, and now he's a bright financial commentator, blogger, author. Gee, I could go on, Pete, but most people would know you by now as a regular on the Michael Yardney podcast. So welcome, Pete.
Pleasure. Thanks, Michael.
Now, Pete, Harry Dent's basic premise is that we're in a bubble and that the bubble must burst. So I'd like to get your take on bubbles. Are we in one and will it burst? But first, maybe I can give you my understanding of a bubble and correct me if I'm wrong. But a bubble to me is an economic cycle characterized by a rapid escalation of asset prices, whether it's shares, whether it's property or whatever. And this rapid escalation, by definition of a bubble, is that it actually has a contraction. And it's usually created by a surge in asset prices that are unwarranted by the underlying fundamentals. And it's usually due to exuberant market behavior. Investors get excited, they push up prices, they borrow too much, they speculate. And bubbles, I guess, can form in economies, in property markets, in stock markets, in business sectors. We've seen it before with the dot-com bubble and price bubbles around the world. Is that a fair assessment of what a bubble is, Pete?
Yeah, I guess one of the things with bubbles, because there is no set definition, that's part of the reason that we get so much debate and disagreement over them. I mean, you could take the view that most of the time markets just respond to stimuli, fundamentals, and most of the times they're fairly rational. It's obviously, in hindsight, you sometimes look back on markets and think, well, that was obviously overvalued, but it's often only in hindsight that people recognize these things. In Australian property, as you know, we went through a very frothy period. It's difficult to remember the exact timing, but I think in early 2017 when the regulators stepped in, because we had so many investors in the market, lots of interest-only loans, and the Reserve Bank and APRA and the regulators stepped in, and that cooled the frothy nature of the market. But again, I mean, essentially markets just responded to the fundamentals in place. So to say that there was a bubble, well, it didn't burst, so therefore, logically, it can't have been a bubble.
Well, we have some features of a bubble, yes, but we're actually not in a bubble. But some people would argue, Pete, the bubblers would argue that the government's taken on too much debt and our economy is going to collapse under this significant amount of debt. Others suggest, well, forget the economy, forget the rest of the world, just average Australian households taken on too much debt. What would you say to them?
Yeah, so, I mean, Australia is in the fortunate position because we went through the resources boom and because we had fairly prudent budget management. We were in a very strong fiscal position going into this crisis. So we've always said that Australia is pretty lucky to have low government debt as a share of GDP. Now our fiscal response is the biggest across the entire G20. So that's one good thing for Australia. Now, household debt is an interesting one. Certainly on a gross basis, Australia has a high level of household debt. People don't often take into account one thing that is very uniquely Australian, that's the use of the mortgage offset accounts and mortgage prepayments and redraw facilities. If you actually net off those balances, there hasn't really been a great deal of change in debt to income ratios in a dozen years, 15 years. The metric I always look at is simply mortgage serviceability. It gives you a much clearer view on financial markets and asset prices. And if you track that back, obviously now we have the lowest mortgage rates in living memory, essentially. And mortgage serviceability, well, it's as good as it's been in the past 35 years. So sure, house prices are relatively high in Sydney. But of course, these days we have units, townhouses, duplexes. So not everyone buys a house, but also the cost of servicing the debt now, I mean, it's as low as we've seen in 3.5 decades, essentially. So that to me doesn't reflect a bubble. It's just a rational uplift in prices.
Well, one of the arguments that people like Harry use is, look how expensive it is to buy a house in Sydney or Melbourne, but there isn't a house in Sydney or Melbourne. There are multiple markets. And why should a first homeowner be able to buy the sort of houses it took their parents 40 years to get? So I think that it's wrong to say houses are expensive, apartments are expensive, when it's actually, as you correctly say, what does it cost to service it? We're not suggesting this easy to get in as a first home buyer, but Peter, it's never been easy. There's always the deposit gap, then there's the serviceability, and then there's the outgoings as well. But before we talk a bit more about property, let's just get back to the bigger economic context. The government has learned from previous downturns. You started to say it's given one of the biggest responses of any country in the world. So they're throwing everything, including the kitchen sink, at preventing us from having a significant downturn this time.
Yeah, so there's really two responses. There's the monetary policy response. So we've already seen interest rates cut to zero. And in fact, the Reserve Bank, for the first time, using a number of unconventional measures. So yield curve control being the jargon of the day. So especially on 3-year government bonds, bond yields at 0.25%, and putting in place funding facilities for banks at the same level. So I guess that's one half of the response is from the Reserve Bank and monetary policy, but then the government, as we mentioned, a huge fiscal package as well. So the combination of those two things is very powerful. Obviously, we have a floating currency as well in Australia, which helps to rebalance things. So it's clearly an economic shock, and that has to be absorbed somewhere. To a certain extent, it's going to be absorbed into Australia's budget position, government debt, and there will be some parts of the economy that take a real hit. So there's no question. But the good news is we will be better placed than almost anywhere else, I guess, in terms of the rebound.
Oh, we're very lucky we're in Australia. But one of the thoughts that Harry and other economists who believe in cycles is putting at the moment is there's a 90-year cycle, there's an 80-year cycle, there's a 10-year cycle. So you're saying, well, it's time because the last recession was in the late 1920s. But the world is very different to then. Regulation is different, governments are different, the Reserve Bank and the federal banks are different. We've learned lessons since then, haven't we, Pete?
Yeah, look, I've heard Harry's forecast, but let's face it, they're not really forecasts as such. They're more headline generators, as they always are. I mean, US stocks to fall 85%. I mean, don't get me wrong, I would love that as somebody who has a lot of cash, but realistically, it's not going to happen. You know, we've seen a correction and a bit of a bounce, but 85%, I mean, yeah, that's drawing a pretty long bow because central bank responses, I mean, compared today to the Great Depression, there we saw monetary policy tightening, whereas now not only are central banks, well, they're no longer reactive, they're actually essentially preemptive now, just tipping in liquidity like there's no tomorrow. The Fed's balance sheet simply exploded trillions of dollars. Yeah, there's not really a very easy comparison to be drawn between the Great Depression and today, even though we're obviously in the midst of a demand shock.
Sure. So it's something that has come up and there is a demand-related shock because even if I do want to go out to Bunnings or go to other places, I actually can't. I'm locked in at the time of us having this chat, but hopefully next week by the time our listeners are going to listen to it, the life will be a little bit freer. But having said that, we haven't come in at a time of huge speculation in the Australian property market, and even in the Australian share market, it really only has just reached the peaks of a decade ago anyway. So there wasn't a wave of cheap, loose money and investors over-capitalising, over-committing themselves this time, Pete?
No, so the timing is somewhat fortuitous in that regard, and we've had something of a becalming of investor activity in the housing market essentially since 2017. So that's a good thing. I think in terms of some of the other responses that the government puts in place, I think the first homeowners grants and incentives will be extended out across the states, possibly even an abolition of stamp duty to try and boost the number of transactions and a switch across to a land tax potentially in New South Wales. So the government likes to see housing prices holding up and actually rising. So don't be surprised when the government intervenes, and it's not, you saw this with the Rudd stimulus, there's a range of things that will happen in response. Nobody's saying that we'll avoid a recession, but yeah, the recovery will actually begin probably from the third quarter this year.
So we're not arguing that there won't be a recession, even though some people are suggesting we may actually avoid it because of iron ore exports. But there's definitely a significant slowdown. And the question is it going to be 1 or 2 quarters, maybe even 3? But then the International Monetary Fund, the Reserve Bank, the bank economists, they're all arguing a bit about how deep it's going to be, how long it's going to take. But they're all basically agreeing that there's going to be a significant rebound in 2021. Now, some people love the argument that Australia is different, while others would poo-pah that and say, no, it's not really different. Can I give you some thoughts why I think it's different, Pete? Up till now, population growth really underpinned our property markets. Now, it's also concentrated in our 3 big capital cities, creating a strong demand for housing. We all want to live in the same spot. There's no doubt that for the next year or so, population growth will diminish. There's actually not going to be much immigration as we've closed our borders. But Peter, it's also coming at a time when we're not building much. There's not a huge oversupply. And in fact, there's going to likely be an undersupply of property as the construction industry is slowing down.
Yeah, so what you'll see, Australia's population was running very quick. It was running at about 350,000 per annum. Now, the population will continue to grow naturally simply because we have more births than deaths. People are living longer than they used to. We also have, and this is something that Harry would know, Australia's demographic pyramid is very, very strong, stronger than almost any other country. So even without population growth, we have hundreds of thousands of people in that prime household formation age cohort. All of those people coming into the first home buyer age or the first time to rent a property, natural population growth will probably continue at about 150,000 per annum. I think we've probably lost quite a few temporary visa holders like international students and so on. I think there'll be a very strong push to start flying students back from the next semester. New Zealand's already talking about it. I think it's a temporary thing for the demographic intake. And got to remember, when we come out the other side of this, I mean, really, there's only been 2 countries where their reputations will have been enhanced as a place that's seen as safe and desirable to go, and that's New Zealand and Australia. Even Canada has been smashed by the coronavirus. Britain has. America is, New York is in a real quagmire. In Australia, yet again, maybe by luck or maybe it's the vitamin D, but we seem to have dodged a bullet.
We'll talk a bit more about demographics, as you said. It's something I learned from one of Harry's first books, that if you see what's going to happen to demographics, you can see, looking forward, what the demand's going to be for housing, for economy, for schools, for kindergartens. And yes, our demographics is well structured compared to Japan, which is an aging population, because he keeps bringing up the Japan example. Pete, I think the other thing we've got to remember is that we've got a sound banking system. It's well regulated and risk averse. Now, some people are saying, but they've stopped giving dividends and they're raising capital. And that's true, but that's only making them more sound, isn't it?
Yeah, so we're quite lucky in terms of the timing here, in that the regulators have spent a number of years actually bolstering capital requirements for banks in Australia. So they're much stronger now, much better positioned than they would have been, say, before the global financial crisis. There's one thing that is true. Australia's banks have a high exposure to residential property. So, I mean, it's all the more reason why governments are so keen to support the housing market, because it's in nobody's best interest to see a wave of defaults. And in fact, we saw the Reserve Bank and the regulators, they were straight onto the front foot here. Loan facilities, funding facilities for banks, 6-month payment holidays for people who are struggling with mortgage stress. So it's a preemptive move, really, to head off any potential issues in that area. I think we'll probably see unemployment goes from, say, 5 to 10% before we start to work it back down again. So there will be some stress at the margins, but I guess what everyone learned very painfully from the global financial crisis is that a wave of housing defaults is in nobody's interest. And in fact, if you look at it, banks are very reluctant to foreclose on people in Australia. It's just not in their interest to do that.
Very, very different to overseas, isn't it? But here we've got 70% of properties owned by homeowners, half of them without debt. And then those who do have debt, it's often in the hands of those who can afford it. Sure, there's some first homeowners who've overcommitted. Sure, there's some investors who bought the wrong sort of properties, Pete. But a lot of homeowners who still have a mortgage have mortgages that they're refinanced by investment properties, or they're ahead in their payments because they keep repaying at the old rates when interest rates have gone down.
Yeah, so that's one of the things that I have to disagree with Harry on. He talked about a wave of forced sellers because of super funds in property. But as an accountant, I can only follow the figures, and they show that stock listings now down to just 150,000. I mean, this is the lowest level in years. So not only is there no forced selling, people are, new listings are now, they're tracking at the sort of level you'd associate with pre-Christmas levels. In other words, virtually no new stock coming on at all. And total listings are way down. So not only is there no forced selling, people are just basically deciding to pull up the ladder and hold on.
So Harry suggests that our properties, the value of your home and my home and our investment properties could drop 40 to 50%. What could cause that happen? If there is a major depression, I mean, if he is right and the whole of the world implodes, that could cause property values to crash. But I don't think any major economist is suggesting that's on the horizon. Massive unemployment definitely could if there was a wave of defaults. But you've already suggested, Pete, that the banks are giving holidays on mortgages, so the unemployment rate is going to go up, and it's mainly going to be in the young demographic, and I guess sometimes in the older demographic, and a lot of those aren't home buyers, owners anyway, I should say. Or if we get exceedingly high interest rates that people can't afford their mortgage, the Reserve Bank's not going to do that, for 3 years. Or if there are too many properties available on the market. To me, they're the four things: the depression, the unemployment, the high interest rates, or too many properties that would create a wave of forced selling. None of those are on the horizon at the moment.
No, and I think borrowing costs is the big one. You know, I follow people like Cameron Cusher at REA Group because he has a real handle on what's going on. He has access to the leading indicators, got real-time data on what people are actually doing. And it seems that in some parts of Sydney and Melbourne, there have been little 5% corrections. That's what the valuers are reporting, bits and pieces like that. But there's really no sign of material declines. Property searches, that's one of their best leading indicators at REA Group. They're up 41% from a year ago. So sure, some of those people are probably just bored and looking at the value of their house. But as a leading indicator, with the borrowing costs at the lowest level in history for Australia, or certainly in modern times, people are going to be looking at places to put their money beyond this recession, and real estate will be probably the first place they look.
I think there's another element that some of the overseas people don't really understand, and that's Australia's culture of home ownership. It is different to overseas. You're originally from Britain. We can hear your accent, but you're a student of the world as well. So in the rest of the world, a lot of people expect to be tenants all their life. Here, people would rather eat dog food than give up their homes.
So it's something we do have in common with Britain. Britain had a 70% home ownership rate that eased back because of the financial crisis and the credit squeeze. So it's a bit lower today, but it's very much ingrained in people that you save hard for your first deposit, you buy a home. It's actually ingrained into the tax legislation as well, that you get capital gains tax exemption on your place of residence. So that hasn't really changed. And it's one of the reasons, of course, that real estate is such a divisive subject, because most people aspire to owning their own home. And as you said, people would sell their cars, they'd sell their golf clubs, sell their kidneys, but they don't let the place of residence go. That would be the last thing to go.
It's because of this culture of home ownership, the government encourages first home buyers. So as you suggested with the Rudd stimulus and way back with the Hawke stimulus when we had a downturn, I can see that that's going to be a way of greasing the wheels of industry, getting people into the property market, because then they're going to buy televisions and refrigerators and all the rest. So there's incentives for home buyers. But the government also recognises that over 30% of the population are tenants, and they're not able to provide the accommodation for them. They depend on people like you and me and the people listening to this show to provide that. So the government wants us to own property, Pete.
I mean, it's a key part. There's a guy, James Whelan, friend of mine, and he talks about the theory of stuff. And modern economies are essentially founded upon young people hooking up, buying their first place of residence, furnishing it, buying things to go in their property, and then consuming. I mean, that is essentially what modern economies are founded upon. I think in terms of tenancies, I think actually that's one of the areas where we will see a bit of a downturn for the housing market, because there's a lot of people with Airbnb properties and student rentals, and a lot of those, I think, especially in the CBD of Melbourne and the CBD of Sydney, those kind of areas. And we're just starting to see that now in the rental figures. The median rental price advertised is lower than it was, not much, a little bit. That's skewed lower by this low grade sort of Airbnb / student rentals. And it will take some time for that to wash through. But as you always talk about, that's why we recommend investment grade properties, not studio apartments or high rise flats that only really appeal to a small demographic.
Well, as we keep saying, there's not one property market. So some properties, A-grade homes, investment-grade properties, they are going to drop, but maybe 5%, 7%. B-grade secondary properties, they're harder to move at the moment. No one's buying the C-grade properties at the moment. So I guess overall, I believe there probably is going to be a 10% drop in property values, but that doesn't mean your home, my home's going to drop that much, because of the sort of qualities of our investment grade properties are going to drop as much as that. And you're right, it'll be very much skewed to some of those new house and land packages in the outer suburbs where young families are having difficulty financing the purchases that they committed to a year or two ago. I can see a lot of trouble with the new and off the plan property markets. And there's going to be still a lot of people, despite the unemployment, who are still going to want to upgrade, downgrade, buy a new home, move. So there are transactions happening. The markets haven't stopped. They haven't hibernated.
No, there's a bit more off-market activity happening now. But I remember listening to Chris Joy at Coolabah Capital, who you'd know well, saying a few weeks ago, well, he said housing prices will probably either just be flat, although it'd fall no more than 5% before resuming their cyclical boom, driven by low borrowing costs. And of course, the usual backlash of people saying, no, you're wrong. But in April, prices, not only did they not collapse, they actually went up a bit. When we look back on this, it will probably be more like a blip in terms of the housing market, simply because borrowing costs are so low now.
Well, I have respected Chris Joy's opinions for a long time. He used to write for the Financial Review more frequently. He still writes for the Financial Review. He's been an advisor to the Reserve Bank and to governments. But he's got the right track record. He's actually got it right. I like listening to it because in some ways it confirmed what I wanted to hear. So I thought it was important for you and me to hear what Harry had to say, so that we don't have confirmation bias, to at least look at the other opinion. And I think we've both come to the same conclusion. He's passionate. I'm sure he believes in what he says, but that doesn't make it right, does it, Pete?
No, and I mean, to a certain extent, a lot of experts' forecasts, if you like, turn out to be garbage. And, you know, Harry's had his fair share of shockers in the past. I know he doesn't like to confess to that, but we remember, I think it was 2011, said that prices would more than halve in Sydney, because I actually saw him around Sydney CBD, looking at his A to Z map. It's 2011, he was doing the speaking tours. And as you know, we didn't get a halving in prices. In fact, prices went up. But you could say the same in his most recent book, The Great Depression Ahead, I think it was, where talked about the Dow Jones going to, somebody would have to correct me on the number, 3,800, and it ended up at 29 or 30,000. I mean, if you can get forecasts that far wrong, you have to question the value in forecasting. But as you've rightly pointed out, you don't buy the housing market, and you actually buy individual assets. So you need to look at it on your own portfolio basis and just make some common sense decisions.
Well, thanks for bringing some perspective to this. And this is the perspective of having been not just in the property market, but also in the stock market, the shares, and understanding businesses and equities. That's why I was keen to get your thoughts. Look forward to having you back again on the Michael Yardney podcast real soon. But before we go, I'd like to not only just mention your great blog at petewarden.blogspot, but your regular blogs on Property Update, but go Next Level Wealth as well. But you've started your own podcast in what I find a very interesting niche. Would you like to just tell us a bit about that, please, Pete?
Yeah, so our podcast series is called Low Rates, High Returns. You can find it on Apple, Spotify, Stitcher, SoundCloud. And that's myself and Stephen Moriarty. And we just talk about the current low interest rate environment, which, as Michael said, that'll be with us now for probably the next decade, and how people need to position themselves to invest successfully in this very different environment. So it's Low Rates, High Returns is the podcast. There is a book that goes alongside it. And if you want to get a free chapter download, it's just at www.lowrateshighreturns.com/book.
Well, I'll leave a link to all of those things in the show notes, because I listen to your podcast, I read your blogs every day, and therefore I'm more than happy to recommend them as well. We'll catch up again real soon, Pete. Thank you.
Pleasure. Cheers.
Well, now you've heard two opposing points of view, and I hope we're able to burst Harry Dent's bubble and you're not too scared about our future. Now remember, in the next week I'm going to have Robert Kiyosaki on the Michael Yardney podcast, where you're going to hear another contrarian view, somebody who's got slightly different views to me about what's ahead, but that's okay. It's part of our learning experience, isn't it? So if you learned something from today and you got some benefit from it, why not tell somebody? Share this podcast with others. Please send the information about today's show to somebody who you think would benefit from it. And if you really liked it, why not tell the world about it by leaving a review on iTunes, Stitcher, Spotify, wherever you listen to this podcast. I'll be back again real soon, twice a week with the Michael Yardney podcast. But in between, you can catch me on social media at Michael Yardney or my daily property update newsletter. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help?